Well, insurance, it is a big, important need for your family. You may, start a family, get the mortgage, have kids, and you want to make sure that if anything happened to you, you are financially protected. We've all been to funerals of people of all ages, and some of those have left families behind that are still young and dependent on them. I'm a big believer if you've got debt and or dependents that you should protect them and protect your income and all that stuff. But Retire Right today, as we get into our 50s, into our 60s, maybe the kids have left home, maybe the mortgage is being paid off, when do you cancel your life insurance? And we are going to talk about it today. We'll jump straight in because Sharon says it really good. And so does Karen. So does Geraldine. How do you know when you're overinsured as circumstances change, e.g. house is now paid off? Karen, is there a common age where people tend to cancel insurances because of cost? Maybe 50s. Sharon, at what point do you jump ship and cancel insurance? Is there a dollar threshold or age, or is it assets versus debt? Assets versus debt. Mate, what would you say to someone, namely Geraldine, Karen, and Sharon?
Yeah, it's always a tough one when it comes to insurance. As you age, the likelihood of claiming on these insurances goes up. So you're more likely to claim, but therefore the cost goes up significantly. So it is always a personal situation. Are you reliant on your income? And will have a really significant impact on your retirement savings if you didn't have that income. And, how do you balance that retirement savings of, my insurance premiums are eating into my retirement savings. And so, there's always a balancing act there. So it is, again, one of the great things that I like to talk about when it comes to personal insurance. It's not an all or nothing. It's not a jump on the ship and keep my $1 million of life insurance or jump off the ship and cancel. You can dial it down. So as you get closer to retirement, it is really important that you are looking at your personal insurance cover within your super fund, and maybe it's just dialing down the cover year on year to keep the premiums the same. So that's one way to really manage that increase in cost, is just bringing down the levels of cover. The worst thing you can do is just ignore your insurances and let it just keep going, because the premiums will really start skyrocketing.
And then I guess secondary from that, just snap and cancel it all.
Exactly, yeah. So. And that's why I've seen that a lot, is, not noticing or paying much attention to my super policies, and then, one day looking at it and going, oh, there's $5,000 a year or $10,000 a year, and, we've got to get rid of it completely because it's really eating into our retirement savings.
Yeah. So who are you and where are you from?
So I'm Phil Thompson. I'm the CEO at Skye Wealth, and we're a big supporter of this podcast family.
Yeah, and what are we listening to?
Retire Right podcast.
Oh, gosh. Well, There we go. You're listening to Retire Right. Let's get into the show.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
So if we break this episode up kind of into a couple of sections, we'll talk a little bit more about cancelling and reducing cover or self-insuring, and then we'll talk a bit later about some costs inside and outside of super. But I think I want to position it when Karen said, is there an age where you have to cancel it? This is with insurance and your financial situation, because it's all so personal, and whether your investments, your investment properties, your home, your rent, all your expenses, you can't just think there is a line in the sand for anything financial, because everything is so different for every single person. We had a question in the Facebook group the other day, and they said, what's a good insurance company for my car? really hard to just hear someone say, oh, GIO or NRMA or AAMI, because what car do you drive? Where is it parked? Is it in a high-risk zone? Is it not? How old is the driver? All that stuff. So it's okay to just say each year I'm going to review my financial situation based on my current circumstances and make an informed decision. And I think when it gets to that death cover, the disability cover, the income protection cover, as we do get into our 50s, you touched on it. Statistically, it's hammer time for heart attacks, strokes, cancer in our 50s. Just a year on year, because if you don't do that year on year, run your eyes over it, it could be getting really expensive and you might not need all the cover. I think it's fair to say, and I'll say this and then I'll walk back the comments, if the kids have left home and you've got no debt, there is probably a very, very, very low chance of needing death cover. What do you reckon? And that's, I don't want to be that binary, and I'll caveat it, but the debt and dependence are a big thing.
That's right. The only thing I would think about is a lot more Australians are retiring with debt still,
and
with a
later
mortgage.
on.
Yeah. So the actual age of which we are holding a mortgage, it's getting higher and older. So that's the only caveat I would think about. If you still have a home loan, which my parents retired with a home loan still.
Right.
And so that's the only time where you may consider, actually, is it worth keeping? But outside of that, I generally agree with you.
Or if you've still got the home loan, so if you might retire 67, 65, 60, insert date here, the mortgage is still there, might be $200,000. But you've got 900 grand in super, you might step back and take the view, well, there's enough assets in our life. And it goes back to always hunt for the need. Is there a need there?
And, and the other thing that, it's a little bit crass to say, but if you're in a partnership and one of you pass away prior to retirement and there's a super balance to fund that debt, it's actually cheaper now to live your life as an individual, financially speaking, and you can clear that mortgage. So as you said, there isn't actually that need because that retirement savings can fund that, leftover mortgage.
Yeah.
But if there isn't a big pile of money in that retirement savings, then it's a matter of going, well, I know it's going to hamper our retirement savings even more holding this life insurance policy of $200,000, but maybe it's really important still.
Yeah, and I think it is. You kind of led to where I wanted to go, and I'll use my own parents as an example again on this show. Like when they retired, they still had a death policy each, and I think it was a couple $100,000 each. And the way that it was set up, it was really cheap for their age and the level of cover. It was a couple of grand a year, a couple $100,000 in death cover. The need wasn't there at all because they had a good super balance. They had no debt. But I think, and this is the psychology of that retirement thing, just going cold turkey and cancelling it felt a bit weird. I'm like, well, why don't you guys just keep it for a couple of years? If either of you died, financially everyone's going to be okay, but an extra couple $100,000 is not going to hurt. And then, after time, because they were just reviewing year on year, just made the call. Yeah, you know what? It's been 2 years since we retired. It's going to suck if we cancel it today and die tomorrow. And I think that's the psychology of it.
That's the hardest thing. The what if we need it.
But if you sold your car, would you beg to pay for car insurance each year?
Yeah,
that's right. No, but we're dealing with non-tangibles.
Yeah, and post-retirement is relatively easy. We actually don't need it post-retirement. It's just pre-retirement. And I know we've got some more questions to go through, but Zurich, which is one of Australia's largest insurers, talks about over 20% of people are stopping work earlier than they want to because of their own ill health. So that's the difficulty when it comes to insurance policies and just saying, well, I'm X age, insert age here, I am 55, I am 60, so I don't need these insurances. Well, as we know, and you've done plenty of episodes on the Retire Right podcast about, those last few years of working is really when you start ramping up your retirement savings. So if 20% of people are retiring early, yes, sometimes you've got to balance this. Well, yes, it is a premium cost. It's going to eat into my retirement savings, but will it help fund, this early retirement because of my own ill health or not?
So I think it's important to note we're talking about life insurance, and I think, the last 10 minutes, it's probably been more of a quote-unquote death cover conversation, because in life insurance land, there's the death cover, which is also called life insurance, but there's the umbrella of death cover, total and permanent disability cover, income protection insurance or salary continuance, and trauma cover / critical illness. Now, this is the interesting thing. Let's have the example of someone in their 50s. They turn 53 tomorrow, and they started early with the kids, and the kids have left home. They've done really well with clearing the mortgage, and we are still 10, 12 years from quote-unquote retirement. Then the disability cover enters the chat, doesn't it? Because we have our income protection to produce our income. So it could be that, okay, well, we don't really need this death cover, but we're still working and we still need to generate money because we've got financial goals, and part of that financial goal might be, I'll make a thing up, let's say 50% of our income so we can have a good quality retirement and still do the things that we need to do. So there's still a question there that, well, we still need our income protection insurance, because if we couldn't work tomorrow, where is the money going to come from?
Yeah, exactly. Yeah.
And even short term, like a year.
And that's where, you said it right. There's the death cover, which is the life insurance, and then there's the living covers, which is if I'm disabled or if I'm unable to work or if I have a critical illness, well, there is money there to pay for that. And they're actually the policies that go up, considerably in terms of the cost of cover as you get in your, over 50s. But again, it's, and this is the issue when it comes to insurance, life insurance, is there's always this what if something happens just after I've cancelled it. And we've got to take reality as well. And we've got to take our feelings into the case. But, as I said, back on that stat, over 20% of people are finishing work early and not able to hit their retirement savings goals because of their own ill health. A big percentage of people, over 15% are retiring early because they're caring for someone else. So not even just their own ill health, but someone else's ill health as well, which is not an insurable thing. We can't insure our, caring for someone else. But there are a lot of cases about, well, we're retiring early, we're shortening that, our Excel spreadsheet says I'm retiring at 55 exactly on the dot and I will have X amount of savings. There are these things that we've got to plan for. So sometimes having a buffer when it comes to insurance that, yes, it's costly and it will impact our long-term retirement savings, but will it have a benefit that we want to pay for?
And, back to that income protection thing in our 50s, house could be paid off, awesome, kids are left home, awesome. Oh, this income protection's, it's getting up there in costs. Well, okay, let's look at what we can do to reduce the premium. Do we bump out, we're still on a 30-day waiting period. Let's bump that to 90 days. We probably don't need to insure the full income because, we could maybe beg, borrow and steal, but we just want a little bit of cover in there.
Yeah.
So can we reduce the insured amount to massage that cost?
That's right. And if you're doing any transition or retirement strategies and putting a lot of money into your super savings, maybe, yes, it's going to increase impact our retirement savings and we're not going to have as much, but we're going to reduce our savings. So yeah, let's only cover 50% of our income or 40% of our income. And that's really where I say review every year and come back to it and go, is this important to us? And so, so we don't get to the 5 years in and you look at the last 5 years of premiums, you get really grumpy and then you cancel it, which is, what I tend to do is get grumpy and snap. Yeah, exactly.
Hey, there's a very interesting question here from Brendan. When should you stop paying for life, TBD, and income protection? I'm 61 with a secure job and lots of leave. Where can you get unbiased advice, not from insurers? Are there tools for this? A couple of things. It's a very interesting point on the income protection, Brendan. Lots of leave will assume 6 months, for example, right? And you're 61. If your income protection has an age 65 benefit period, what can happen is once you start getting closer to that age 65 benefit period, the weird thing happens where your premium will start to decrease in the last years of the policy. So that's just one thing to note. The second thing to note would be, where can you get unbiased advice? Well, you could pay, for example, Skye Wealth. They will do an analysis and basically ask you questions and make a recommendation. But I would pretty much say the first thing is, if you couldn't work tomorrow, Brendan, so if you woke up tomorrow and you couldn't work, you're over 61 or you're over 60, do you have a significant savings in your superannuation to make sure you'll be financially okay? So maybe, Phil, because it's a really good question to wrestle with, maybe the question is, at 61, can we get some actual retirement advice? And when the advisors are doing the retirement advice, they can, part of that strategy, go, well, based on this, we haven't factored in any insurance and you'll be fine without it. Done.
Yeah, and I mean, the bit I wanted to tackle was the unbiased advice, because unfortunately, when you're dealing with human beings, you're going to get a bias. So if you go to a retirement specialist who actually doesn't do any insurance, that's not what they do. They're going to have a bias towards cancelling those policies because they may not have worked with clients who have gone through a claim. If you go through an advice firm that does a lot of insurance and they're helping clients make claims on their policies day after day, they're going to have a bias towards maintaining that policy, not because they're
even
getting
if the
paid
data
or,
says there isn't a need. Do you think they would fabricate a need?
No, I don't think they'll
bias?
fabricate a need, but it depends on what the need is. Like, again, I'm pro insurance. I like insurance, but I have also personally almost begged clients to cancel their policies because the cost was literally 50% of their income.
Yeah,
and I'm saying cancel this.
Yeah,
and
you have to live in reality.
And they were saying no, we really want to keep it, And then next year, I had the same conversation. Hey, it's becoming a really significant impact on your retirement savings. Let's consider dialing it down. And so I've been in both scenarios where I'm pro insurance. But again, what is the need? Maybe there's no need. Well, again, it depends. Depends on the retirement savings of this individual. If they've got a lot of money and they're working because a lifestyle, they choose to, they want to, then maybe there is no need.
This goes against everything, but there's a very high chance that Brendan at 61 with a secure job and lots of leave probably doesn't need any insurance, on the assumption that no mortgage, no dependents. And we'll assume that Brendan, or insert name here, because we can't give personal advice on this podcast because I don't even know if the person's name's Brendan. They could have put their fake name in. There's probably a chance that they don't need any insurance. Maybe. Brendan, ask your wife, hey, we've got all this insurance. What do you feel like? Would it be comfortable for you if we just had $100,000 little buffer? Just as a comfort clause. If the answer is yes, we'll keep $100,000 of death cover. You might not need it, but if it makes your spouse or partner feel a little bit more secure, do that. So I don't know where you can get unbiased advice.
I just don't think you'll ever get unbiased advice because
No.
everyone brings their own experience to any conversation.
But I can tell you, if you're 61, no debt, no dependents, and you've got a healthy super balance, you might be okay.
The difficulty is
But I
that statistically, Brendan won't be in that situation.
No.
Because
Well, a lot of our listeners are pretty dialed in.
They're loaded, are they? Well, great job. Great job for the listeners. But, statistically, Australians, we're just not retiring with a huge chunk of money in our super.
But then
We've had compulsory super
dance,
for 30
right?
years.
This is the dance, right? If there was a need that he still needed 200 grand of death and TBD cover, but at age 61 it's 20 grand a year.
And that's,
if you earn 500 grand a year, sure, you might go like whatever. But if you're earning 100 grand a year, I'm not spending 20% of my income on insurance. I'm taking the risk.
100%. And this is where it comes down to, if there is no need, it's an easy decision because there's no need to keep it.
Yeah.
But if there is a need,
would you take money from Brendan, and if he's got a spouse, and do an insurance proposal?
Would I take money from them? Would I charge an appropriate fee?
Yeah.
Yes, I would.
Yeah, well, that's what I'm saying.
Yeah.
All right. Helen took out cover years ago for the kids. They're adults now, but not financially strong. Should I keep it going for them? Well, if you didn't, okay, here's the question, Phil.
I like this question.
Yeah, so if Helen, you had heaps of money, like $3 million of cash in your bank account, and the kids are not financially strong, do you have a desire to help them? If yes, under what circumstances?
So would you be telling Helen, maybe keep it?
Well, I'm just saying to Helen, what's financially strong? Are they freeloaders addicted to meth? You want to go there.
Yeah. And it's funny because, I take the...
Or are they dialed into their career and not financially strong because they live in Sydney and it's so hard to get a first home?
They just haven't been able to buy a house yet. All of that.
But this goes back to, it sounds like the need isn't there at all. It's a, I want to.
Yes. Yeah. I would be more strongly discussing with Helen to cancel. Well, it's actually no need. If you're doing it for your adult children, and if you were to pass away, would there be funds flowing to them anyway? If the answer is yes, then does that extra $500,000 of life insurance need to be there?
Yeah.
I would more strongly talk to Helen and say, adult children can probably fend for themselves, and there's a cost of living crisis, and we can be empathetic as much as we want.
Yeah.
But I wouldn't be jeopardizing Helen's retirement savings to fund the adult children.
This is what we don't know. Took out cover years ago for the kids. They're adults now, but not financially strong. I wonder if it's a child policy that's now flicked over as a trauma and she's still paying for it.
Okay. Well, that's...
But then, no. But then it would mean it would go to their names.
No, but she could still be funding it.
Paying for it, yes. So that's what we need to know. And then the question is, hey, kids, you've both got a friggin' 200 grand little death TBD trauma or whatever policy it is. Mum over here is paying $100 a month for you two freeloaders. Do you guys want this policy or not?
Yeah. So just to unpack that a little bit. So, as parents, you can have child cover, and then when the children become adult, it converts to a full adults policy. And you can keep paying those premiums for your children. If that's the case, I would be strongly considering for Helen just to say, here's the bill. Do you want to start?
Yeah. Hey, kids, I'm doing this. If you want to continue the policy, awesome. Or this, when it goes back to Helen, are you happy to give the kids a monthly premium? It's like if Helen's got $1 million cash in the bank and she wants to do it because she wants to donate her $1 million when she dies to the RSPCA or whatever, and this is it. These are fun to think about because we don't know all the details, but it all comes back to, do you want to pay money out of your account to help your kids?
Yeah. And for me, this discussion is more, because, depending on the age of the kids. If the kids are 21, they're going to say no to a $20 a month bill for life insurance or trauma. But having a more rounded conversations about the benefit of insurance for young people, it's still incredibly important. And Helen believes it's important for her kids to take over those policies. Have a robust discussion with them about it.
Philosophically, if it was what I thought it was, that she took out cover years ago for the kids, aka I took a policy out for me with them as beneficiaries, and now they're adults, so technically they don't need it, which I'm half thinking it's more the latter, that it is maybe
A child's cover.
a child cover converted. We don't know. But if it is, she's got a policy that's $500,000, a death cover on her, it's costing her $200 a month. They're not financially strong. They would probably benefit for that cash each month now that she's paying the premium to go towards their rent. That could be, if you do want to help your kids, it's more of a question of what's a better use of that help each month.
Yeah, exactly. And again, I mean, let's say it's $200 a month for $500,000. Like, it's one of these things when it comes to insurance, depending on how old you are, like, Helen's not going to be able to save that much money to give it to her kids, that $500,000. Even that $200 a month in premiums, you're still not going to save $250,000 per kid, assuming there's 2 kids. And so insurance does have, there are some benefits of, like, if there's like an estate equalization when you're retired, there are some areas where insurance is really important, it can be a great fit for that.
Yeah.
But if it's literally I just want to help my kids if I do pass away early, at some point you're going to have the conversation of, when do I actually cancel this policy?
In terms of, I'll just kind of touch on that there. Phil mentioned estate equalisation. I'll be very round numbers and not outstay my welcome here. If you had the house worth $500,000 and little Johnny, he loved that house and he helped Dad, who passed away a few years ago, renovate it, and it just meant so much to little Johnny. As part of the estate equalisation, if that was the only asset, you could say, well, we're going to keep this death cover in place of $500,000. So if I die, little Johnny gets the house worth $500,000 and little Mary gets cash of $500,000.
That's right.
That's equalised.
Yeah, because Johnny can't go to the bank and borrow money because he's financially not.
Yeah, and we really wanted little
ready.
Johnny to keep the house because little Mary didn't care about it, but Johnny, and dumb thing, but that's how the estate equalisation works. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Remember, if you want to join the Retire Right Facebook group, just put "Where did you hear about it?" Put the episode number. If you're listening or watching on YouTube, what up, gangsters? Put episode 3, whatever, into that so we know that you're not spam. In finishing, Phil, Colin, the costs inside or outside super. Colin, I had a really good chat with him in the Facebook group, but can you just explain for those who are new to the insurance world, what's this inside versus outside super and default cover and group cover and all that?
Yeah, so most super funds will set up a default level of cover for their members. If we're talking to the Retire Right community, it'll be relatively small amounts of cover on a default level because it does decrease significantly as you get older. But that default level, the super fund will provide for you. Now, if you go and set up your own individual policy, you can do that, direct to some insurance companies, but you can go through a financial advisor and we can help set it up. Now, the benefit of going through an advisor is an advisor can help set it up so your super fund can fund a lot of the premiums, can be really tax effective way of paying your premiums, but the policy is linked to you as an individual and not linked to your super fund. So if you do move super funds over the next 5-10 years, then you can maintain your insurance policy.
So the reason I wanted to chat about it, it stuck out to me because I'm like, that doesn't sound right. Because you can set up a policy with a financial advisor that is often, and I will say more times than not, more cost competitive than increasing cover through your super fund.
Yep.
A stronger quality product in terms of benefits and definitions. And then you've got personalised help if there's a claim or any stuff. Like the jury is out. Personal retail cover in this climate is usually more appropriately priced and featured, even with the built-in commission that goes to the advisor to service the policy, than going to your super fund for additional cover. Jury is out.
Yeah, it'd be interesting to see what quotes Colin got.
Well, here we know the exact reason, because he originally said, I looked at alternative provider for income protection, life and TBD recently. Can you see his blurb there that I copied?
Yeah.
There. Much more expensive than staying with the current super fund. And I thought, it's very odd that it would be more expensive going to an alternate provider than the super fund. And basically, this is what I'm going to read what Colin said, and then we'll unpack it just to help people understand default cover and additional cover in super. We had a bit of a chat, and you can just research Colin or truck driver in the Facebook group and you'll find this. Glen James, I remembered why it's so different. My existing policy occupation is rated as professional, quote unquote, and the quote from Suncorp was truck driving. So I think that would account for the increase. I tried to change from professional to blue-collar occupational risk within my superannuation insurer, but they advised by email that it was not necessary unless I increased the amount of cover. So I'm covered sufficiently at what I considered a very fair cost. The professional risk rating can save people a lot of money over time, and it is not automatically applied, even if you're obviously in a professional role. May be worth mentioning. Cheers, Colin. So do you see what's happening there?
Yeah. So, I mean, I'm going to assume that Colin set up the policy with the super fund when he was in a more professional occupation.
Can we maybe just talk industry for a sec, just so we're on the same page?
Yeah.
The default policy set up, professional, done, called them to increase, and they were basically like, well, we've got to do professional the truck driver rates, or went to another provider and go, no, you're a truck driver.
Yes, yeah.
You can't change the occupational rating on the default cover because it's default.
Well, no, I think Colin tried to change the occupation rating, and they said you don't need to unless you increase.
That's right. So you can't change it on the default, but if you increased within the super fund, that increased portion would be truck driver.
No, I think what they're saying is you don't have to change.
Right.
You can change the default to blue collar, but you don't have to because your policy is already in place and it was set up as a professional occupation.
The group policy,
The group policy, yeah.
Okay.
Moving to a higher risk occupation over time, you don't have to update the insurance company. But the group cover said you will need to disclose that occupation rating if we go and increase it.
The group cover did.
The group
yes,
cover,
that's what I mean. Yes. Yeah. So how do you explain what's happening here? Because initially we're not talking apples with apples until we got to the bottom.
Yeah, correct.
Okay, so what's happening here?
So with insurance policies, when you set up the cover, it's based on the occupation you're doing at the time you set up the cover. And so if you set up and you're an accountant, you set up your policies, and then you go and become a truck driver, you don't have to tell the insurance company that you've changed occupations. They'll still base the claim as if you're a truck driver, but the policy will be priced as if you're an accountant. Now, if you go and increase your cover, they will ask your occupation again at the time you increase your cover and will rate the whole policy based on your new occupation. So what Colin's done is he's compared the truck driver premiums
of the new policy
with Suncorp. You mentioned Suncorp.
Yep.
And then compared it against the professional occupation of the group default cover.
Yeah, which is not apples for apples.
Correct.
So that's why I perked up and was like, hang on, much more expensive than staying with the super fund. But if Colin had default cover of 300 grand in the super fund and went to the super fund, who wasn't Suncorp, which was Australian Super here, and said, I want more cover inside the super fund, that additional group cover, would they occupationally rate that?
The whole thing would be assessed under that truck driver. Yeah, would be.
Okay, and that's what I wanted to know.
The whole pricing would be gone.
Even on the default cover, they would change the default cover.
Yeah, correct.
Okay. So all that to say, when you see sweeping statements like this online, That's why I had to check. I had to just like, ooh, it doesn't sound right. Don't take advice from a podcast or even this podcast or a Facebook group.
Or a Facebook comment.
Or a Facebook comment. You need to get your own advice based on your own situation, because things can get lost in translation and people get scared off. And it's just a really good discussion here based on what are some of the things that impact the cost of an insurance policy.
Yeah, so I mean, just to round off this thing with Colin, like it's actually good that the super fund didn't let him change the occupation.
Yeah.
Because the insurer could have said, great, we'll update your occupation to truck driver now and charge your premiums accordingly. But he didn't need to. And you actually don't need to when you're with your insurance policies.
And some insurance companies and group policies may not insure certain incomes.
Yeah, exactly. Yeah.
So truck driver is, if not the most, one of, I would say, top 5 most risky jobs to do in Australia. I think you've got underwater mine clearance diver, truck driver, and plumber.
Yeah.
Because you can get a lot of turds. Nah, I don't know about plumbing. But so it's very nuanced. So talk to us about what makes the cost of an insurance policy.
Yeah, cool.
The
so,
main things.
Yeah, there's a few things. So things like occupation is a massive one. So professional occupation versus a truck driver will have, as Colin noted, massive discrepancies in premiums. It's not because one insurer is worse than the other, it's because of the occupation. The other thing is male and females have different rates for different types of policies as well. Now, if you're a smoker or non-smoker, that'll have a really big impact. The level of cover, so if Colin's gone and quoted with another insurer and said, I want $1 million and compared it against his $134,000 with the super fund, well, those premiums will be massively different as well. So there's a whole bunch of things that comes into play. Other things like health history, medical history, family medical history may come into play. So you may get a loading on your policy for something that is a family health history. So it didn't happen to you, but that can actually increase the premiums or can add an exclusion on your policy. Right. So there are a lot of things that have an impact on the cost of cover. And so, it is easy enough to go and do quotes online, and you can find insurance companies that will allow you to do quotes online, but only until you apply for the cover and get accepted will you really know what the end cost is. And, if they increase the premiums between the application and the policy being accepted, they've got to let you know what those increases are. But there are a lot of things that can have an impact on your cover.
Yeah. So anyway, we might leave it there. A bit of a chat. I just wanted to get the message across that when you're looking at whether I cancel my insurance or looking at quotes and prices, one, it's just such a personalised thing. You cannot ask people, hey, what's everyone paying for their car insurance? Can't ask that. People have got different cars, worth different amounts in different suburbs, and people have bad driving history that's impacted.
Yeah.
Like, it sucks. And I think the only thing I would say is when you're asking for recommendations for insurers, and I'm talking car insurance, home insurance, life insurance, has anyone had any good claims experiences and what insurance company? That's a better question than who's the best insurance company on price.
Yeah. Yeah, as we said, there are some insurers who will be better rated from a pricing point of view based on the occupation, and some that will be worse rated. So it is a very individual scenario. Yep. And most people, when they say, "Oh, I'm getting ripped off with this insurance company," when it comes to car insurance, they don't really tell you that they've had 5 car crashes in the last 2 years, and that's why their pricing's
Or when someone says, "Oh, I'm paying $10,000 a year for my death cover," well, they could be 58 years old and have $3 million of insurance.
Yeah. And it's really important, as you said, to make sure you get advice. Like, our job at Skye is we really just want to, educate our clients to understand the policies that they have and give them an assessment based on what we believe is important, but then empower them to make a choice that they're comfortable with. So they can, we can have these robust discussions like we've talked about with a number of these questions is this right for you now? Or, it may not make sense to keep this, but do you want to keep it?
Yeah.
Or it may make sense to have it, but do you want to reduce it?
Yeah. And you can do whatever you want. And if someone says, why are you paying for that when your kids have left home and you don't have any debt? Here's the answer. 3 words. I want to. My name's Glen James. This is
Phil Thompson.
And if you found this episode beneficial, or if you liked it, give us a little like on YouTube here, or a little rating on Spotify or Apple Podcast. Thank you so much. You can find Phil at Skye Wealth, skye.com.au, or there's a link in the show notes if you want some insurance action from Skye Wealth. We'll see you guys soon.
Bye.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.